Okay, this is Mani Karthik here. Hope you're all doing good and fine wherever you are. We'll be soon starting the webinar. I'm just waiting for everyone to join in. We have the panelists and our guests here. And today's webinar is on the topic, better investment and taxation options for NRIs returning to India. We're joined by two experts from this field who will educate us on the topic and answer your questions. Mr. Mohit Ralhan, who's the Chief Investment Officer at TIW Private Equity, and Pratik Dodia, who's the CEO of Alphabet Investments. We've done one series of webinar, one session of webinar a couple of weeks back, which touched upon a very broad topic of investment options. Mohit comes with a ton of experience in the private equity investment sector and have helped many with his experience. Pratik too is an expert in this field and helps NRIs make the right choices in terms of investment, investing their hard-earned dollars. And both of them have agreed to educate us on the various investment methods and specifically a few products that they might recommend in today's webinar. We'll also be looking into taxation options today, which is a very sought after topic, as many of you would already know in the community. I'm also expecting questions from the audience. So if you have any, feel free to ask them in the Q&A box and we'll pick them up towards the end of the session. Just a quick word about Back to India, the community. I started this community when I returned back from India in late 2017. And ever since, this has been a community-driven effort. And we're a community of 10,000 plus NRIs from different parts of the world today, hoping to return back to India soon. And we help each other with the information we've gathered through our experiences so that those who are planning to make the move can do so with ease. Apart from the main groups, which many of you are part of, we also have city-based groups where local and city-specific information is shared, like Hyderabad, Bangalore, Delhi, Mumbai, etc. So if you wish to join one of them, please check out the link that I'll be sharing towards the end of the session in the chat box. So without any delay, let me invite Mohit and Pratik to the stage. Mohit and Pratik, thanks for agreeing to do this session. Please go ahead and enlighten us on what are the best or better, I would say, investment options available to NRIs today and the different taxation options you would recommend. Over to you.
Thanks a lot, Mani, for introducing us. Warm welcome to everyone. Thanks a lot. Myself, Pratik here. Thank you everyone for joining us on a Saturday morning out there. It's a pleasure to always interact with this group. This is my third session which I'm doing with you guys. A lot of you must have attended previous sessions. Today we are going to have an interesting discussion around fixed income investment option which we have from TIW, which is an interesting fixed income option which Mohit will cover largely in his presentation from TIW, and post that I'll be taking part on the taxations for NRIs returning to India. So probably next over an hour we'll try to cover this. Without wasting much time, let me welcome Mohit as well. And over to you, Mohit. Yeah.
Thanks a ton, Mani, and thanks a ton, Pratik. What I'm going to do is I'm going to keep it simple. In the next 15 odd minutes, I'm going to take you through a presentation. My colleague is just going to upload and share the screen with the presentation. So allow us 30 seconds for that. But just to set the context, it's been a 2-decade experience. Today at TIW, the Indus Way, we have investors from 21 countries, including 12 states of United States of America, and across 6 funds, 4 recessions, 60 plus investments, $1.5 billion returned back to investors in all funds I have been with. But if I have to make a one-line resume, I have to say that we have never ever lost a penny for any investor. We say with a lot of pride that I think the first priority is always principal protection. And then, of course, the second priority is returns. In my previous engagements, I was with the Baring Private Equity Partners, where we also had institutions like California State Pension Fund, one of the most respected funds, Calipers. We had Columbia Endowment, AT&T Pension, General Electric Pension, Government of UK CDC, Government of Netherlands FMO, Government of Singapore GIC, Government of UAE Abu Dhabi Investment Authority, Government of Qatar QIA, and the likes, United Overseas Banks. These are the kind of names we had as investors. So fairly blue chip. The product I'm going to talk about as an investment opportunity is extremely relevant in today's times. If you look at last 44 years, 4 decades, 44 years to be precise, the global bond market has been in a bull market. That means fixed income products have given reasonable returns. Of course, interest rates have been falling, and hence the price of these instruments have been going up. However, there is a general belief that the decade 2021 to 2030 is going to be a decade of inflation. If you look at the data around, in the last week, the United States of America inflation data pointed to a 13-year high. Canadian inflation is at a multi-decade high, and every country is moving upwards. While a lot of central banks believe it is transient in nature, we don't think so. We believe inflation is here to stay. Reason, if you look around, the labor cost is going up. The salary hikes have been pretty decent and are at, for the last 10, 15 years, we haven't seen these kind of salary hikes, including in United States of America. So whenever there is a labor cost increase, typically inflation tends to be higher and is stubborn. So what will happen? Levered products which have leverage, like structured notes, bonds which have leverage, those kind of products will have pressure in terms of giving returns. When the cost goes up, when the interest rate goes up, the riskiness of levered products goes up. So this is an extremely important point, independent of what I'm saying in terms of our product design. This is extremely important point to understand and appreciate. In that context, I am going to talk about a fixed return product. A fixed return product, essentially there is no asterisk. It's a completely fixed return format. And whatever we say is what the investor gets. So let's start quickly with the next slide. So in any investment strategy, if you see, there are fundamentally 6 things any investor looks at: a dollar protection, safety of principal, optimum holding period, of course, capital has to grow, regular liquidity and income, and diversification. So the product that I'm going to talk about today is a fixed return format. So let's look at the next slide. If you see, the tenor of the product I'm talking about is fairly low. It's hardly 2.5, 3 years. This is a global product. It's a multi-asset, multi-geography product, and the investors can invest in dollars or in pounds. 40 to 50% of our money is in Western Europe and US, and around 50 to 60% is in Asia, primarily Southeast Asia and South Asia, completely dollarized or pounds. So investors can either invest in dollars or pounds. So the returns are ranging from 9% dollar to 11% dollar and fixed in nature. This is like a savings plan. So whatever you invest, depending on the quantum, the return is fixed in nature. It does not change. So there is no variation or there is no risk of return changing. An extremely important point to highlight. So let's look at the design of this format now. So if you look at the design, basically there are 4 buckets an investors can invest in. $100,000 is the minimum. Second slab is $250,000. Third slab is $500,000, and the fourth slab is $1 million or above. Let's take an example of a client who puts $100,000. It's to be paid over 12 months, 50% now, 25% in 6 months, and 25% in 12 months. Immediately from the day the money is received, return starts accruing. So for this case of $100,000, the fixed yield is 9.6% in dollar. It's a fairly attractive yield. And whatever is accrued in first 12 months is paid to the investor as dividends in the 13th month. I'm going to talk about taxation. That's a very important point. So I'm going to talk about taxation subsequently, but essentially it leads to, something very important, that whatever is accrued is essentially paid back to investor from 13th month onwards. Now, moving forward, the returns are quarterly. So after 13 months, quarterly the investor continues to get dividend basis these yields. So 4 quarters after 12th month, the returns will continue. And most interestingly, from the 25th month, investors can redeem. So in 25th month, 31st month, and 36th month, investors can redeem 1/3, 1/3, 1/3. It's an option, not an obligation, or not necessarily, it's a must that the investor should redeem. Assuming the investor chooses to redeem, the holding period of this fund is hardly 2 years, 2 months. So the first 12 months, the investor pays. Basically, the next 12 months, it is hold, and the next 12 months, redemption. So point is accumulation, hold, and redemption. Hardly 2.2 years tenor, dollarized return, fixed in nature, 9.6% yield going up to 11.25, either in dollar or in pound, and without leverage. There is no mark-to-market risk. There is no margin call. There is no swing in returns. We have also basically filed, today we have investors in 12 states of US, as I said. So annually we issue Form K1 to the investors. So if an investor invests, we will issue Form K1 for taxation filing, and even investors can invest their IRS money, and because that tends to be non-taxable through any platform or account that you hold. Our jurisdiction that we have is Mauritius. I'm going to talk about that later in terms of jurisdiction, recourse, legal recourse, and safety of principle. But I thought it's important to highlight from a taxation perspective that this is a very simple product, and we issue Form K1 for US investors on an annual basis. Let's move forward and talk a little bit more about risk. So my next 5 to 6 minutes is going to be about risk management. Now, if you look at risk management perspective, cash is assumed to be king. So this is a riskometer which ranks from 1 to 10, from a scale of 1 to 10, various asset classes. Cash is assumed to be the lowest risk. Sovereign debt or sovereign bonds, of course, like US Treasury, is rated 2, the next after cash. Cryptocurrency, while returns are great, the variation of returns has been wild, so riskiness is higher. And what we are doing is collateralized debt. So our rating is 3. On a scale of 1 to 10, when 10 means highest risk and 1 means lowest risk, our rating is 3. So that is an important point I want to highlight. Moving forward, let's understand the context here. So while the return part is very clear, it is fixed return format with 9.6% yield on the lowest side. Our entire portfolio strategy, I'm going to talk about the buckets we do, but the entire portfolio strategy is to reduce risk and shift it to left-hand side. What does that mean? On the right-hand side is extreme risk, derivatives, option trading, derivatives, hedge funds. That's the highest risk. On the left-hand side is lowest risk. That's sovereign bonds like US Treasury. So our entire strategy through portfolio management is to bring the risk to left-hand side. An extremely important point to note. So let's basically move forward now and look at the button. The various buckets where we invest. So there are primarily 4 buckets we invest with. Bucket number 1 is life settlement. Some of you who know life settlement products, the industry has been growing at 35% compounded in the US context. This is a US product. And an important point to note here is that the returns have been anywhere ranging from 8 to 14% in dollar. What exactly is life settlement? Today, an insurer can sell the policy to a life settlement fund because surrender value of these policies is very low. Specifically, critically ill and terminally ill insurers, basically, they can sell it to a life settlement fund, get a one-time bullet payment, assign their policy to an institution, the future payments and the future receipts goes to the institution, and the insurer gets liquidity upfront. So it's a very favorable product. There's a lot of activism in US today for insurance companies to actually mention and talk about that the policy can actually be sold to a life settlement fund. And this industry is doing very well last few years and has been growing very fast because a lot of policies lapses, and this segment has no correlation to stock market or no correlation to bond market. A very, very important and an interesting segment to look at. A very safe investment strategy. The second strategy we look at is private credit. What does it mean? While I'm explaining these buckets, it is for giving comfort. The idea is a lot of these have historically created good returns for investors without variation, without any linkage to stock market, without any linkage to bond market. So private credit is nothing. In this case, we are talking about giving debt to technology service companies. Lot of technology companies have good profits. For their expansion, banks will not finance them because banks look at basically physical assets or hard assets as collateral. This segment is doing extremely well and the returns are double digit in dollar. And typically we get as collateral almost 175% collateral as receivable. Bottom line is a very safe way of investing. So large chunk of money goes into private credit in Asia and in other markets. The third segment is essentially, residential leasing, where we get rental income, and this is for corporates. So long-term, leases with large companies where the white-collared employees, let's say a factory is getting constructed. So, we have back-to-back, agreements and get long-term lease of 2-3 years and very good liquidity, strong operating income, and very less risk, because even if we lose a contract, let's say a 2-year contract, simultaneously our cost will go because our cost is also on per use basis. So very simple strategy, but the yields are almost 1.25% a month. So 12 to 15% annualized in dollar is what we make. And lastly, asset-backed financing, which is again a very strong segment. And here in the last 5 years, we have delivered extremely well and 0% loss ratio cumulatively across projects. I'm going to show you the performance in the past, but the bottom line I'm trying to drive here is very effective strategy, not linked to stock market, and very simple way of creating superior returns. So let's move forward and let's see what does it lead to. So an important point to see is that the returns are extremely stable, protected, because we have 175% collateral, zero leverage. There is no leverage. Most products in fixed income have high leverage. That creates risk for the investors. In this case, there is zero debt, zero leverage. We have complete control on right to cash flows. We have complete control on collection because of receivable, that we take charge of. Important point is diversification. I always say that concentration risk has to be less. Imagine your entire money is in one single stock. It is very high risk, but a diversified portfolio reduces risk. Our overall exposure to a single underlying is less than 2.5%. So there is massive diversification. Now, there is going to be one statement I'm going to use, Sharpe ratio. Don't bother about jargon. What this means is riskiness of the underlying. If this ratio is less, then returns vary a lot. It is not good. I mean, Sharpe ratio of 1 or 2 is not good. Higher the number means the riskiness is very low. Returns are predictable, returns are stable, returns are consistent. Imagine greater than 7. Some other benchmarks I will give is likes of Berkshire Hathaway, extremely high Sharpe ratio, very stable return, consistent return, and essentially a very similar, ratio is what we have. So the riskiness of underlying is very low. My entire point here in 2 decades, what we really want to drive is the concept of making sure principal is never lost. Come what may, principal should not be lost for the investor. Now, moving forward, let me give you a simple example of a cash flow. So let's look at essentially a cash flow now. If you look at this cash flow, let's take an example of 100,000 to make it easier. So if you look at a cash flow of $100,000, the investor can invest in 3 tranches. As I said, 50,000, 6 months later, 25,000, 12th month later, 25,000. Whatever is accrued is paid to you in 13th month, again in 15th month, 18th month, 21st month. Now look at the beauty of what I want to drive. The word that we have written here is illustrative cash flow. Illustrative essentially means this is what you get. Unlike funds which talk about expected or projected return, there is no variation of returns here. This is illustrative in nature, which means essentially there is no change in returns. What we say is what you get. Even in the subscription form, this return is actually mentioned. In 25th month, you can redeem 1/3. In 31st month, you can redeem 1/3. Whatever is left, you continue to get the same return. It's a choice. You may choose not to redeem. and in 36 months again, you get 1/3. So if you go back to a previous slide and I talk about the regulatory framework, and I'll also talk about taxation here. If you look at this, an extremely important point I want to highlight is this fund is structured like an expert fund. It's an open-ended expert fund. What does it mean? It means the legal recourse for investors is extremely strong. Not only you can have a class action suit because I have US investors, but even the legal recourse is extremely strong because under expert fund, open-ended fund regulation, even if there is a 1 quarter of interest default or a coupon default, the investor has a right to redeem. The onus is on us to redeem it. Most importantly, during COVID times, we have completely made it digitized. If any investor as an individual want to invest, today, as I said, we have investors in 21 countries, right from Australia to Canada and 12 states of US, including Louisiana, Virginia, and obviously the key states which typically we get investors from Indian origin perspective. The point here is it is digitized. Our backend team fills the form and sends to you. You look at it, you just need to have internet connection, submit it, straight away goes to our administrator. Our administrator is Apex in Mauritius. Apex manages $1 trillion as a custodian globally. As a fund administrator, they manage $1 trillion odd. So it's a massive scale. And essentially, you get a wire transfer request, you transfer it. So very simple way of getting onboarded. Going to the cash flow slide, a very important point. Whatever returns you get it as dividends. So what is the nature of taxation on this return? This is one investment strategy which is extremely tax efficient way of investing for NR and for international investors. Reason, in countries like Singapore, Middle East, of course, even in African nations like of Kenya and some others, global dividend income is tax-free. Global dividend income is tax-free. And in US and even in markets like UK, this will get added in your annual income. And we will issue Form K1, as I said, for you. So it's a very simple way of investing. And the entire return you get, there is no complication. It is either you getting as your principal back or you getting it as dividend income, which is a global dividend income, which gets added to your income in especially countries like US. So with that, I'll just like to spend a little time in, about the team, just a minute odd about the team. So apart from me, we have Mr. Satyamurthy. He's working with the European Union in Spain. He's also retired Deputy Comptroller Auditor General of India, pillar of governance. He's also the first honorary CEO of the Anti-Corruption Academy. We also have Mr. Vijay Kishore Sharma. He is a UK resident. He was head of Greenlace Bank in 90s, for the merchant banking. He was country head for that. And he's on our Mauritius board. And we have Mr. Kamlesh Gandhi. He has been a veteran, has done 320 IPOs and capital issues in last 4 decades, literally selling one company every 45 days. So the pedigree of the advisory board and council is very strong. And essentially a very simple strategy. Just to highlight, TIW globally manages 200 million Singapore dollar, globally as active asset under management. But cumulatively in all funds that we have paid back and in funds I have been with, we have paid back $1.5 billion to investors. So with that, I'd like to end my discussion. Thanks for showing patience to go through. I'm extremely, happy to take any questions and clarifications. And over to you, Pratik, to take it further, to talk specifically about taxation aspects and anything else you want to share. Raji, you can please pass the host rights to Pratik.
Thanks a lot, Mohit. I thought it was a wonderful presentation, taking everyone through the fixed income investment option. Raji, you'll have to, okay, you've already given me the host option. Okay. So what I'm largely going to cover today is, let me just share my screen.
Pratik, this is Mani here. Just a quick thing before you start off. Just wanted to give a shout out and remind the attendees that if they have any question, please feel free to post it in the Q&A box so that we can take it towards the end of the session. Go ahead, Pratik. Sorry.
Mani, just give me a minute. I'm just setting my presentation up.
Sure. Absolutely.
Meanwhile, you want to share anything, you can do it here.
Sure. Yeah, just take your time. No worries. Just wanted to make sure that we have the Q&A box open. So I'm seeing already questions coming in. So keep that coming in. I'll probably curate and take them up towards the end of the session. I'm assuming that we'll have a lot of taxation related questions because that's what always pops up whenever there's a personal finance related topic or question posted in the community. You're ready, Pratik?
Yeah.
Okay, take it away. Thanks.
Okay. You can see my screen. Yeah.
Yes, Pratik, go ahead.
Okay. Just a minute. Okay. Okay. So I'm going to cover the part of the taxation NRIs returning to India. What are the taxation issues generally what we face? Broadly, I'll be covering introduction in terms of what questions one should ask oneself, categorization of individuals in terms of resident, non-resident, and then taxation, bank accounts, which you all can open, maintain the accounts, renting versus ownership in terms of you planning to settle in India, then what are the options, what you should consider. Bringing back money to India if you're coming back for good. And obviously, most and important thing is the financial decisions, which you need to take in terms of your investments and insurance. And little bit we'll talk about the Indian economic story also, and just about us in terms of Alphabet, what we do, what our model portfolios have done returns wise, and that's where we'll conclude. So as I start, I want to start with questions what one should ask himself or herself, before coming to India. Do not sit on the fence, but should ask these questions to yourself. A, do you plan to uh, come back, with the option that you are planning to come back for good, in terms of permanently, or you want to keep the option open, whether you want to go back. This is very important. A lot of people are still, might be in that phase where they are not sure whether they want to, come back for good, or they might be looking to, return back to, US as well back. Second is obviously whether you're planning to retire or work in India. A lot of us are in that stage where you might be returning back because of the family reasons, or might even, you might have retired from the work and eventually want to settle in India for your own retirement. And last and most important thing is which city you plan to reside in, because it would depend upon if you're coming back to work. Then if you're a IT personnel, you would like to probably go back to, say, Bangalore or Hyderabad, because those are important cities from there. If you belong to financial industry, you might look to come back to Bombay, or if you are retiring, then you might even choose which state you feel comfortable retiring in, maybe Goa or somewhere. Yeah. So moving on to the next slide. Sorry, one second. Yeah. So basically, what we are looking at, as an Indian resident, you have 2 3 options. Obviously, how do you classify a resident Indian? A person who stayed over more than 730 days in last 7 financial years. If you have stayed more than 730 days in last 7 financial years, then you classify as a resident Indian, and in at least 2 out of 10 financial years. Yeah.
Pratik, I'm sorry to interrupt you. Can you switch to the full screen mode if you don't mind? Because
yeah, I'll do that. I'll do that. Just give me a minute. Actually, I was trying to do that, and I thought it
click
happened.
on slideshow and full screen.
Yeah, no, I'm just doing that. Yeah, just
Okay,
give me a
thank you.
minute.
Sorry, go ahead.
Yeah, 1 second.
You can click on that slideshow button on the top, bottom right. You see the slider. There is one button right next to it on the left hand side, next to the slider, bottom right, where it says 42%.
Yeah, I'm just trying to do that. 1 second. One sec, I'll just share the screen again.
Okay. Meanwhile, I can see that there are questions coming in Q&A box. Mohit, if you want to randomly go through those so that you can pick and choose which ones to answer first towards the end of the
This is
session.
better? Yeah, this is better. Sorry. Yeah, sorry for that.
Yes, this is better, Pratik.
Yeah.
Yes.
Yeah. So as we were talking about, so basically, how do you classify a resident Indian? Someone who stayed more than 730 days in last 7 financial years, or at least 2 out of 10 previous financial years. This is nothing but you classify as a resident Indian. Okay. The second point, which is resident non-ordinary resident. This is very important for people who are NRIs and who are looking to return back to India. This is a sort of you become a resident, but you enjoy a tax advantage as a NRI. This is very important for people who are coming back or looking to come back to India in next few years. So basically, what happens is once you come back to India, you still remain you become a resident Indian, but you enjoy the tax benefit for next couple of financial years if you qualified for these 2 points, which is nothing but out of last 9 out of 10 years, if 9 years you have been non-resident and you have stayed less than 729 days during last 7 financial or tax years, so you continue to remain a non-resident Indian from a taxation point of view. So that's a advantage, what one gets over, as a NR resident, non-ordinary resident. And obviously NRI, we know that if you have stayed less than 180 days in a given year, then you continue to remain non-resident Indian. So how to take advantage of it, we'll discuss in coming slides, in few slides, that how you being a resident Indian still can take advantage of, NRI, RNOR taxation. Okay, the screen is... One second, sorry. Yeah. So what is the benefit, income tax benefit for RNOR? As out of last 10 financial years, if 9 years you are non-resident Indian, and in last 7 years, if you have stayed less than 729 days, you get that benefit of RNOR. So basically you get additional 2 years, 2 financial years or 2 taxation years where you are resident Indian, but you have an advantage to tax as non-resident India. That means you don't pay income tax on any income which you have accrued abroad, and you have that 2 additional financial year to get your money back to India. Suppose if, for example, let's take you have a house property or some income or some investment which is maturing in next 1 or 2 years. You don't need to break it today. You can get it over a period of next 2 financial years, anytime between in next 2 financial years, and still you are not taxed in India. This is an advantage one can avail of being a RNOR. And obviously we'll talk about you can get additional 3 financial years if you can time your return back to India. That's very important. We'll discuss that in detail in the case study later, what I'm going to talk about. Taxation part, a lot of people keep on asking me if you're, we being in US, we are already taxed on our global income. So then how does it work? So once you come back to India, and if you are already having some US assets, which is maturing, or you are receiving an income in form of your 401k, where you are already taxed, that means India has a double taxation avoidance agreement with US. That means you don't need to pay tax again in India with on the income which you have already paid in US. So what it means is you are not going to get double taxed. If you are paid in US, you have to declare it in your income tax, and you are not going to pay again tax in India. So let's take out the first point. You're planning to sell an overseas property or withdraw money from your overseas retirement account. It is advisable to do it when you have a NRI or RNOR status. That will mean that you don't end up paying tax in India after 2 years. That's the advantage you have. Even if you do later stage, what will happen is you'll be taxed in US, but you won't be double taxed in India. You'll have to pay tax on the difference. In case you are taxed lower in US, then you'll have to pay tax in India. And again, second advice or tip number 2 is based on your return, what you can have is advantages. You can stand to enjoy this benefit for 2 to 3 years, depending upon your investments. So suppose say you have some investments which is you have made enough capital gains and you want to book the gains, then it's best advice to book it while you are looking to return next 3 years, which will ensure that you don't end up paying tax in India again. Whether it is done in equity investments in India or some other investments, which will actually help you to do that. Even on the rent which you receive from your overseas property, or withdrawal or pension from overseas retirement account, or interest or dividend what you earn in overseas deposits or securities. Just to simply put across what is ROR, RNOR, or NR. Nothing but ROR means you are a resident Indian, which is my case. RNOR is someone who's looking to come back to India. Probably if money had come back to India, for example, say last year, then he's RNOR. NR is someone like you who's already a non-resident who's not come back to India now. So everyone has a different taxation. A resident Indian will be taxable in all the cases. Now, RNOR won't be taxable in case of income is accruing and arising outside India from other income for next 2 years when the person is RNOR. And non-resident obviously will not be taxable on income arising outside India because it's not taxable in India, as well as any business setup which has been done outside India is not taxable in India. So we are going to just look at a case study. Suppose say a person who's 60-year-old US resident who's looking to return back to India, what would ideally would happen in this case? Someone who's say 60 years, and is looking to return back to India. Typically, once he comes back, suppose say we are taking a presumption that he's been outside India for last 10 years, 10 financial years as a non-resident Indian. Then what happens is he gets a benefit of RNOR. He won't be taxed for next 1 or 2 years. Even if he stayed less than 729 days, that means he gets advantage for 2 financial years. So suppose say someone who's coming in 2022-23 post October, that means less than 180 days, October 3rd, he's staying less than 180 days in India. That means that his status will remain non-resident in India because he stayed less than 180 days in India. He's technically coming by after October 3rd, because we follow April 1st to March 31st as our taxation year. So technically he is staying less than 180 days in India. So he continues to remain as NRI, non-resident in India. In 2023 and 24, he will become an RNOR because he's non-resident in last 9 out of 10 years. And he will continue to remain RNOR because he's been less than 729 days out of last 7 tax years. So he gets an advantage of being RNOR for 2 years and NRI for 1 year. So technically, he can have 3 financial years or 2.5 years from a standpoint to enjoy that tax benefit once he comes back to India and wants to take care. But this requires a little bit of planning. As I told you, if you plan to come back, return back after 3rd October, you are technically being an NRI in that financial year, and next 2 years you can be RNOR. So technically you remain an NRI for next 3 years. What is the taxation for NRI or NRI on various equity investments or fixed income or property? Typically taxation in India is very clear across all investors, whether it's a resident Indian, NRI or RNOR. They are basically taxed at 10% in case of dividend distribution tax. On capital gains, short term it's 15 and long term it's 10%. On fixed income, or you can say any debt investment in property, there's a capital gains. 30% is less than 3 year is 30%, and more than 3 years you get 20% plus indexation. For property now it's become 2 years instead of 3 years, but the taxation remains same. So if you stay invested more than 2 years and you sell the property after 2 years, you get indexation benefit. This is just a working what we have done for our capital gains, for the investors understanding. Again, this is a double taxation avoidance agreement. So you're not going to get taxed twice, in US and India. This is just a taxation case study for comparison of fixed deposit and a debt mutual fund or a equity mutual fund, or whether you call it a debt investment or a equity investment. Typically in a FD, you don't get any taxation benefit. Once you become a resident Indian, you end up paying 31% tax on your FD. Vis-a-vis debt mutual fund or equity mutual fund, what happens is you get this indexation benefit, which is nothing but inflation. So suppose say you had invested, say for example, 10 lakh rupees, and if you make a 6.5% interest rate, which typically is the current interest rate right now, you end up making 12 lakh 7,949. But since inflation is around 6%, you get a indexation benefit for the same for next 3 years. So this minus your inflation, which is your indexation cost, you don't pay up tax on the entire amount, you pay the taxation on the differences of between this maturity value and index cost. So actually your tax value is much lower in case of fixed income mutual fund or a investment option compared to a FD, and same is with the equity mutual fund. So what happens, you get an advantage if you are looking at investment options apart from fixed deposit. Even what Mohit has discussed, that can be a very good tax post-tax return investment option for a lot of NRIs, as well as you being in US, you can avail that advantage of taxation. What are the accounts one can hold once they return back to India? A lot of people have that. Can I hold my NRE and NR accounts once I come back to India? No, technically no. Once you come back to India, within 6 months you have to close your NRE and NR account if you plan to become an resident Indian. You need to close your convert your NRE and NR account to a resident account, and you can open a RCF account, which is nothing but resident foreign currency account. Foreign currency account is nothing but it will allow to bring back your money in form of foreign currency, whichever currency you want to get the money back. Typically, a dollar account, you can have a foreign currency account where you can get your foreign currency back into this account. Overseas account, no harm in keeping them open as long as you declare it. It will benefit you if you need to make a money transfer back to the country, in case you need to do that. And obviously, we have spoken about, NRE, NRO account needs to be converted to, your resident account, which is your normal ordinary resident account. Coming back to this question has been cropping up to us many times, once we return back to India, should we buy a house or should we rent it out, or which city should we buy? So it would depend on a lot of factors, which city typically you are looking to settle in. Obviously, it would depend upon in what stage of career you are. Are you looking to come back to India and get back to work, or you're looking to for a retirement home? Are you considering to shifting to another city in future because of whatever work point of view? So all those things will derive will depend upon all this question. Once you have this answer to this question, it becomes easy to take that decision. Obviously, investment in property, there are advantages and disadvantages. Disadvantages, obviously, it's a illiquid investment. We know liquidity is something which is difficult. Rental yields are also low. Capital appreciation is there, but we don't know right now. We are going through a phase where there is a quite bit of supply. So yeah. So obviously, ideally, if you are looking to buy a house, you should, if you are looking to take a loan, and it should be looked from a tax saving purposes and nothing else, which should give you some tax benefit. What are the key important financial decisions one has to take? This is where our job comes in. A lot of people fail to struggle to plan their investments. So we actually help them plan their help them plan their retirement planning. Because in India, government doesn't not take care of your retirement. You need to plan it for yourself. Whether it is your estate planning, life or insurance, health, financial investments or retirement planning can help you with everything. These are some of the investment options what one can have, whether it's a bank fixed deposit, bond or fixed return investment, what we have discussed, what Mohit covered today. So typically what we have seen is that bank yields have come down. So people are looking at alternate fixed income option, which can give better returns. Obviously, real estate is something which one looks at, residential or commercial. Private equity, which we also recommend for our clients, where TIW is specialist in buyout private equity strategy, direct equity, or mutual funds, depending upon investors' risk appetite and goals. Just to shed some light on India has become now a $3 trillion economy, where Indian market cap has hit 3 trillion. In terms of GDP, we are around 2.6. So we are still, long way in terms of the growth path. Projections are that in next, probably next 3 to 5 years will be about $5 trillion economy, which is expected by 2025-26. So let's hope that India aims to be a $5 trillion economy by 2024-25, and it's a wonderful journey which we'll see in next 5 years. If we hit that, that means market will also double from here with the economy. So there's a lot of growth opportunity in India. I'm sure a lot of you all are already watching it in terms of growth. In terms of our model portfolios, we run various model portfolios depending upon clients' expectations and return. We have a growth strategy, which is a 100% equity portfolio. We have a moderate strategy, which is around 70 to 80% equity, 20 to 30% gold, debt and gold. asset allocation strategy which keeps on rebalancing between equity, bond, depending upon the market valuation. And then we have a conservative strategy which aims to deliver stable return through debt allocation and has a little play on duration. So typically a fund like TIW fixed income, which can give a conservative strategy, but a fixed return to our investors who are not looking to take any risk on equity, would come into a conservative strategy. So what is our job? What we do? We actually focus on asset allocation. We help investors trying to, investors tend to always, follow the asset returns, but that eventually ends up, investors we have seen end up burning the hands. Typically, let's take recent example of 2020. In 2020, start of the year, someone would have said, I want to put money to equity, would have not thought about asset allocation. By March, he would have lost 30 to 40% of his wealth due to COVID scenario, right? Post-COVID, the market crash, which happened in March 2020. And out of fear, he would have moved out of equity completely. He would be sitting on a 30-40% loss and would have never looked at entering equity again. But ideally, if someone would have planned for a pure asset allocation, he would have been, say, 50-60% into the equity, another 20-30 in bond, and some 10% in gold. His impact on the portfolio would have been only 10 or 15% because gold went up, equity did go down, but gold actually helped portfolio to protect. And during the course, obviously, then post the March, what we have seen next 1 year is equity moving up. So investor would have made money out of equity and not have made any loss. So we try to avoid biases what investors have looking at last 1 year or 2 year return. We rather focus on asset allocation, help client decide the asset allocation depending upon their risk. What we try to control is the risk, cost, time, and the behavior. What obviously we cannot control is return. No, none of us. But most of the time, investors focus on return. They don't focus on risk, cost, timing, time, and the behavior. Time is very important to the investment. Depending upon your time, your risk, the return is a outcome of all these four factors. So focus on asset allocation. This is what message we want to drive, and this is what we help investor plan, is focusing on asset allocation and on their investment goals. This is what we have done for our investors. Typically, market would have done about 4.5 times in last, say, 15-16 years. But we would have grown the wealth by about 10 times. And this is our portfolio returns. All the returns above 1 year are compounded. Alpha growth is our equity portfolio. Alpha balance, which we spoke about, is our moderate or balanced portfolio. Asset allocation is more of asset allocation between equity and bond. It keeps on rebalancing. Conservative is typically a conservative portfolio, which is more of a bond portfolio and less of equity. And defensive is 100% bond portfolio with AAA or high AAA portfolio. This is in terms of our service. We are into wealth management, mutual fund, EMS, fixed income. We have various investment options. Fixed income is what we covered today from Mohit side, TIW. And we help in estate planning, wealth transfer, financial advisory, and demat of shares and physical shares. That's our team from Alphabet. Pranav is there on call with us. Neil is part of the marketing. He heads our marketing. Myself, Pratik, I'm the founder and CEO for Alphabet Investment. Spent about close to 17 years now in the industry on the investment side. And that's it from our side. We are based out of Mumbai. That's our contact details and email ID. That's my contact number. You know, thank you everyone for hearing to us out patiently. Over to you, Money. In case any question, more than happy to take it. Thanks everyone.
Great session, Pratik. Thanks a lot. A lot of insights there as usual. Great. Let's go to the questions. So I see that there are a couple of questions already posted. Let me just figure out which ones to go first. So Arvindan Tirunavakurshi is asking, is it fair to say that there is no capital appreciation on the fund and will receive dividends only, similar to FDs or corporate bonds? I assume this is going to Mohit. Mohit, do you want to take a stab at it?
Yeah, sure. Absolutely. And perfect 10 on this. The idea is to look at the fixed income allocation of your portfolio. And this is essentially a savings plan. So answer is absolutely right. I mean, in the question itself has an answer. So this is going to be no appreciation or depreciation of capital. That's equally important. And you continue to get dividends in a fixed return format. And once either you redeem or the life cycle is over, which is 3 years, you get your principal back. So there is no concept of increase in principal or the NAV or concept of decrease in principal or NAV. So it's like fixed principal and essentially, you get your dividend.
Got it. Is it okay? Sorry, Aniket Chandra is asking, if we sell a house that we have in US after we move to India, which country taxes us on the income and under which tax status? He's also asked question 2 on 529 plans. If our children don't use it for education 15 years from now and we withdraw the money, attracting tax on it, what tax liabilities do we have from US and India on the income?
Okay,
Either
if
of
we
you
sell
can
a
go
house,
for it.
sorry,
Or
yeah,
Mohit.
you want me to take this? Yeah. If we sell a house that we have in US after we move to India, which country taxes us on the income? And depends upon when you sell the house. As I told, as we speak, if you sell the house uh, till the time if you are RNOR in India, then you won't have any tax in India. Still, you get that advantage. But obviously you will be paying some tax in US because you're selling a house there. But you get a complete tax-free advantage in India. You don't end up paying any tax in India. But if you do it once you become a resident, then if there is any difference on the taxation between two, suppose say for example in US your taxation is lesser than you and in India you're supposed to pay higher tax because it is added to your income back, then you'll have to pay on the differences of the tax. If uh, your tax in US is more, then you don't end up paying any tax in India anyways. So it would depend upon the capital gains tax in US, what is the tax for the sale of property, in US.
Got it. Makes sense. There's one from Akash who's asking, how are funds invested, insured, or which government agencies, if any, backs these instruments discussed by Mohit? Like a bank account in the USA is insured by FDIC.
Sure. So there are two things here. The regulator is clearly the Financial Service Commission Mauritius, because the funds domiciled in Mauritius for one simple reason, that it has double tax avoidance treaty with 140 odd countries. And of course, given that we have to market in multiple jurisdictions, it is treated as an offshore fund for US investors. But two things. One is because we have US investors, class action suit is clearly possible as a recourse for US investors, because we do file as I said, blue sky forms for individual states from where we get investors, whenever we have an investor investing with us. So that's one. So that's purely from a legal recourse standpoint I'm answering. The second point is on the concept of capital protection. Very clearly, I want to highlight two things here. We have zero leverage. It's been 2 decades, and it's not by chance that a California state pension fund, which is bluest of blue chip, would invest in something like this part of the world so easily. So we are very clearly having zero leverage. So what it does is all the underlying assets of the fund as a charge. Now I'll explain what the charge means, but as a charge, as the first charge goes to investors as a downside protection. Let me explain. When you take a home loan, you go to a bank, you take a loan, the bank will take charge of your asset, which is the property in this case. So similarly, when we go and buy all the assets, because there is no underlying leverage in these assets, there is no banker who also has land. So every element of the asset, we completely own and control. And hence the first charge of all these assets goes as a downside protection to all our investors, an extremely important point. So in case of anything which goes wrong, obviously all assets pro rata will go to the investors under law. More importantly, I want to highlight the way we have filed. We are an expert fund. It's an expert fund. Expert fund means, by the way, our minimum has to be $100,000. That's another, fortunately, unfortunately, you can call it. You can't do less than 100,000 because the recourse for an investor in an expert fund is extremely high. For example, if we default even 1 quarter of dividend payout, then under law, you have a right to redeem. It's an extremely important point, and our neck is on table, and the onus on redemption will be on us. So I've answered two different points. One is from a legal recourse standpoint, which is extremely strong, and second is from protection of capital, which is through first charge of asset by ensuring there is zero leverage. Money.
Got it. Yeah. The Aniket is asking if you could answer his second question, either of you, and I'll just repeat it. And that's on 529 plans. If our children don't use it for education 15 years from now and we withdraw the money, attracting tax on it, what tax liabilities do we have from US and India on the income?
Okay, so yeah, just let me just refer that question. For 529, if I don't use it for education for now. So obviously I have to, for the US part, I'll have to come back to him, because that is something we'll have to check, because in India, again, if you are, RNOR or NRI, you won't be taxed in India. But on the US part, we'll have to check the tax liability, on those things. Yeah. So I won't have an answer, but we can definitely come back to him, if you don't use it for education, then, and if you withdraw it. So probably, I can, if you can share his email ID or money, I can come back to you and you can share it with him for this one specifically.
Yeah, and just I'll be sharing the contact information for all the attendees on email, so you can directly get in contact with them as well. So we can take any such questions offline. And if you have anything specific, you can also ping me on WhatsApp as well. All of you have my number. Let's go for the next question, which is from Balaji. And he's asking, would F1 student for 2 years and 7 years on H1B, so that's total 9 years, qualify for R&R?
So depends upon, as a student, he's been someone has been completely his status has been NRI, then yes, they can qualify for RNR. Because what RNR status says is, out of last 10 financial years, 9 years, you need to be NRI as a status. Whether you're a student or H1B, it doesn't matter. As long as you are NRI, that's what matters. But as a student, he status, whether he had filed as shown as NRI or no, that would depend, on his taxation in India, what he had shown. Someone would have shown,
Got it. Next question is from an anonymous person. I believe Roth IRA and Roth 401k return is tax-free during retirement in US. If I'm in India at the age of 65 and withdraw money from Roth 401k, will I have to pay tax on it in India?
Yes, actually you'll have to, because if you're in India and I believe you are resident Indian, then yes, you have to pay, unless you are an RNOR, that then you get, as I told you, that 2-year window to bring that money back and you don't pay any tax. But if you are a resident Indian, yes, your income is added to your global income, which is taxed in India. But again, if it is taxed in US, then you don't pay to that extent tax in India. So from a double taxation avoidance agreement, But if you are not taxed in US, you have to pay tax at the rate which income slab you fall in India.
Okay. Another question from Srikant Rao, and that is, if I have my RSUs that I got when I was in the US, and he's now in India, and if you want to sell it, can I use my US current account to transfer the proceeds? Would there be any tax issues in US?
For the US part, we'll have to check because it would depend, so we can speak to our US tax consultant and come back to him, because some of this are finer issues which I might not have immediate answer right now, but definitely you can check and come back to them. Yeah.
Got it. We'll take one more question from Balaji, and that is, once someone moves from RNOR to ROR status, will any contribution withdrawals before 59.5 years, which is the US retirement age, from a Roth IRA be taxed by India? Asking because Roth IRA is a tax benefit provided by the US. India does not have to honor it, right?
Yeah. So basically, what happens is, if he's if he's a resident Indian, then he has to pay it. He has to pay tax on it, because what Indian tax system says, any global income what you receive, you will end up paying tax on it. Whether it is through a retirement benefit or any benefit. Because that tax benefit is only provided by US. India does not have any, so he's absolutely right. India does not have to honor it. You'll have to pay tax on it. Yeah.
Okay. I'll throw a question to Mohit just to switch things up.
Yeah.
This is a follow-up question from Akash, and he's asking, as you mentioned that minimum investment required is 100K, what is, if any, insured amount? PIC insured up to 250K. Mohit.
Okay, so irrespective of amount, even if it's $2 million, we have 175% collateralization for entire fund investment that is available to investor as a charge or recourse on a pro rata basis. So what it means essentially is, if an investor puts in $250,000, then into 1.75 times is the collateral. If the investor puts $100,000, then into 1.75 times is the collateral. And in case of an event of even a default of 1 quarter of coupon, which is the dividend, please note that you have a recourse which is prescribed under the law and importantly in a subscription agreement for you to redeem 100% of your money, at an instant. And more importantly, you can, in case of default from our side to even redeem that, the charge of these assets in specie will get distributed to you. So on a lighter note, if that happens, you will end up getting appreciation of your money. There was a question asked in the past that, is this like an FD? I said yes. But in case of this situation, because the collateral value is far higher, you'll actually end up getting a higher value in specie in terms of distribution. So irrespective of quantum, it is 1.75 times collateralization.
Got it. A question for Pratik. This is from Gaurav Salia. If US stocks are sold while on RNOR status, will the capital gains be tax-free in India and US?
RNOR status applies to only India. So definitely, if you sell US stocks when you are an RNOR and you bring back money to India, you're not taxed in India. But that does not mean that you won't be taxed in US, because US has its own set of taxation on your equity bit. Yeah. So you'll have to pay your tax in US, but in India you won't be taxed.
Got it. One more question from Arvindan, who's asking, how is RNOR beneficial when I get the returns, rent, or sale of investments or real estate when I'm paying the tax overseas, as I already paid the tax abroad and there is no double taxation for both new resident versus RNOR? What is the difference in this scenario?
Yeah, so typically benefit would be if, suppose, say you are not taxed overseas, and or taxation in India is more than overseas, then you get that advantage. Because typically, if you have an asset which is taxed only at 5 or 10%, or it's not taxed overseas, if you bring back the money to India, you are not taxed again. But suppose say asset, once you become a resident Indian, and if you have asset which is sold abroad and it's taxed only at 10%, but it is added to your income when you become a resident Indian, that means your overseas income or your overall income, you're taxed at 30%. So you have to pay a difference of 20% additional tax in India, but which you might get a benefit if you are RNOR. I hope that answers the question.
Got it. Gaurav is asking, is there a minimum investment amount for the schemes at Alphabet Investment?
Typically, we take investments of any amount, so you can start as low as any amount. So depends upon individual what investment options they are looking and what is the so there's nothing as minimum. Yeah, but we ideally want investors to look at least minimum 25 lakhs of investment to start with. But as we speak, yeah, we can take smaller tranches also.
Got it. Two questions I'm clubbing it together from Sudhir Chaubina. He's asking, what is the tax rate on global income? And what taxes are applicable when transferring money from USA to India? It's a little generic, but if you want to take a stab at it, Pratik.
Yeah. So sorry, first part of the question you said, what is that? Global tax.
What is the tax rate on global income? And what are the taxes applicable when transferring money from USA to India?
Global income taxation is nothing but it's similar to what your income slab you fall in India. Suppose say you are at 30%, which is the highest income tax slab in India, then your global income will be taxed at same percentage. And transferring money from US to India, you don't have to pay any tax as such, as long as you are NR or RNR. Once you become resident Indian, you have to disclose your income from abroad. This is the income which you are accruing, and you have to pay tax. But transferring money does not have any taxation. So if you transfer money, you don't have to pay any tax. Yes. It is what you declare is what you have to pay tax on.
Yes.
And you need to declare it every year in your income tax year.
Got it. Perfect. I think we've kind of cut through all the questions, but feel free to contact Pratik. His email and contact number is flashing on the screen right now. Also, if you want Mohit's contact, or if you want to ask a question specifically, feel free to email me or WhatsApp me. I can definitely hook you up with either of the two experts here. But I think this has been a very useful and great session. So thanks a lot, Mohit and Pratik, as usual.
There is one question
yes,
which I actually thought I'll answer live, which I guess is important for me to answer.
Please go ahead.
Sorry for the interruption. So basically, there's a question where an anonymous attendee has asked, because see, we believe in very serious transparency, and the governance standards, given the number of institutions who have invested in the past with us, have been extremely high echelons. So an anonymous attendee has asked, how are you different from any other private asset management company who impose many underlying costs and rip off the customer, and return of capital is highly doubtful? I thought it's extremely important to answer in everyone's presence. Now, this is exactly what we believe is the reason why investors from 21 countries have been backing us repeatedly. And that is that an entire chart structure is variable. The filings that we have made and is accessible to investors is with 0% fixed charge. We charge 0% management fee, among one of the rarest funds in the world, where for our fixed return product, we charge 0%. When you go to a bank and take a fixed deposit, you don't get a charge, right? You don't.
Mohit, your audio is cut off.
Yeah, Mohit, we lost.
I think he's having some technical issues, so we'll just wait for him to return back. Pratik, do you want to cover up?
Yeah. Meanwhile, participants, you have any queries with regards to taxation, any investment to do with India, anything to do with India, whether it is your income tax return filing, your investments in mutual funds, anything, portfolios to be reviewed, or how do you plan for your investment once you come back to India, or any planning to be done, we can help you do on complete financial planning, financial plan, drawing up your investment plan, planning for your goals, we can help take care of it. Do get in touch with us. You have got the information, details about us in terms of our email ID. That's my number. I'm available on WhatsApp as well. You all can ping me up on WhatsApp, and we'll
Sorry.
definitely come back to you. Yeah.
I'm sorry.
Yeah.
I just wanted to just say this
Yeah.
quickly that
Please.
Yeah, go ahead, Mohit.
very
We were just
important.
waiting for you. Please go
Yeah.
ahead.
Yeah, sorry about that. So this was a very important point to highlight because this is one of our biggest strengths, 0% fixed cost. Back to you, Mani.
Yeah.
Got it. Thanks, Mohit. Thanks for taking up that question. I think that makes a lot of sense. Great. Yeah. So we were wrapping up. So like I mentioned, feel free to contact Pratik on the information that's shared on the screen. If you have any questions that you want me to direct, feel free to ping me and I'll hook you up with Pratik or Mohit. But thanks a lot for joining. We might think of another session probably in a week or two with a different topic, perhaps. So feel free to write to us if you have any suggestions or if you have any questions that we want to take up on that session. But this will be shared later with all of you guys on email with all the contact information and everything. So, feel free to action it from there. But yeah, thanks again, Mohit and Pratik, for doing this and answering the questions. This has been incredibly valuable. Thanks a lot. Thanks a lot, all of you, for joining. Thank you.
Thank you, everyone. Thank you.
Thanks,
a lot,
everyone.
Mani.
Thanks, Mani, as always, for arranging this. Thank you.
Thanks. Bye, everyone. Bye-bye.
Bye.